In the production sectors, industrial production shrank by close to 17% in March, with manufacturing activity down by 21%. The output of core industries, which constitutes about 40% of overall industrial production, contracted by 6.5%. In conformity, the manufacturing PMI for April recorded its sharpest deterioration to 27.4, spread across all sectors. The services PMI plunged to an all-time low of 5.4% in April 2020. Amidst this encircling gloom, agriculture and allied activities have, however, provided a beacon of hope on the back of an increase of 3.7% in food grain production to a new record. A ray of hope also comes from the forecast of normal southwest monsoon by the India Meteorological Department. By 10th May 2020, up to which the latest information is available, Kharif sowing was higher by 44% compared to the last year's acreage. Rabi procurement is in full flow in respect of oilseeds, pulses, wheat, benefiting the bumper harvest. These developments will support farm incomes, improve the terms of trade facing the farm sector and strengthen food security for the country. Going forward, these would also have a salutary effect on food price pressures. The inflation outlook has become complicated by the release of partial information on the Consumer Price Index by National Statistics Organization, obscuring a comprehensive assessment of the price situation. From the incomplete data that have been made available, food inflation, which had eased in January, from its January 2020 peak for next 2 months, that is during February and March. Now suddenly they have reversed and surged to 8.6% in April as supply disruptions took their toll, immune to the ongoing demand compression. Prices of vegetables, pulses, oilseeds, milk and cereals emerged as pressure points. In the external sector, India's merchandise exports and imports suffered their worst slump in the last 30 years as COVID-19 paralyzed world production and demand. India's merchandise exports plunged by 60.3% in April, while imports contracted by 58.6%. India's foreign exchange reserves have, however, increased by 9.2 billion during 2021, that is from 1st April onwards, and so far, that is up to 15th of May, our foreign exchange forex reserves, they stand at 487 billion US dollars, which is equivalent to 1 year's imports. I now go to the outlook with regard to inflation and growth. Against this backdrop, the MPC assessed that inflation outlook is highly uncertain. The supply shock to food prices in April may show persistence over the next few months, depending upon the state of lockdown and the time taken to restore the supply chains after relaxation of the lockdown. Among the pressure points, the elevated level of pulses inflation is worrisome and warrants timely and swift supply-side interventions, including a reappraisal of the import duties. Immediate step-up of open market sales, PDS offtake by FCI to offload some part of excess stocks can also cool down cereal prices and also create room for Rabi procurement. Given the current global demand-supply balance, international crude oil prices, metals, and industrial raw materials are likely to remain soft. This would ease input costs for domestic firms. Deficient demand may hold down pressure on core inflation, although persisting supply dislocations impart uncertainty to their near-term outlook. Much will depend on the shape of the recovery after COVID-19. Accordingly, the MPC is of the view that headline inflation may remain firm in the first half of 2020, but should ease in the second half, aided also by favorable base effects. By Q3 and Q4 of the current financial year, it is expected that the headline inflation will fall below the target of 4%. Thus, the MPC's forward guidance on inflation is directional rather than in terms of levels. Going forward, as and when more data are available, it should be possible to estimate the path of inflation with greater certainty. It is in the growth outlook that MPC judged the risks to be the gravest. The combined impact of demand compression and supply disruption will depress economic activity in the first half of the year. Assuming that economic activity gets restored in a phased manner, especially in the second half of this year, and taking into consideration favorable base effects, it is expected that the combination of fiscal, monetary and administrative measures being currently undertaken both by the government and the RBI would create conditions for a gradual revival in activity in the second half of 2021. Nonetheless, downside risks to this assessment are significant and contingent upon the containment of the pandemic and quick phasing out of social distancing and lockdowns. Given all these uncertainties, GDP growth in 2021 is estimated to remain in the negative territory, with some pickup in growth impulses in H2 2021 onwards. The end May 2020 release of NSO on national income should provide greater clarity, enabling more specific projections of GDP growth in terms of both magnitude and direction. Much will depend on how quickly the COVID curve flattens and begins to moderate. As the nation prepares for this future, the words of Mahatma Gandhi should inspire us to fight on. I quote, "We may stumble and fall, but shall rise again," unquote. The MPC is of the view that the macroeconomic impact of the pandemic is turning out to be more severe than initially anticipated. Beyond the destruction of economic and financial activity, livelihood and health are severely affected. Judging that the risks to growth are acute, while the risks to inflation are likely to be short-lived, the MPC believes that it is essential now to instill confidence and ease financial conditions further. This will facilitate flow of funds at affordable rates and rekindle investment impulses. It is in this context that the MPC voted to reduce the policy repo rate by 40 basis points from 4.4 to 4%. If the inflation trajectory evolves as expected, more space will open up to address the risks to growth.